We have a gentleman from the ECB who worked with us over the past year, Riccardo Pizzeghello. He is staying up all night to help us out and to talk about, since he couldn't travel here, to talk about the way that he is helping the ECB look at using some of our tools for banks that are not listed. As you may know, we rely upon publicly available data for returns on banks in the marketplace. But what about those banks that are not listed? How do we think about assessing their capital shortfalls in the event of stress? So, Riccardo, thank you for joining us. Thanks for staying up. And let's take it away.
Yeah, thank you very much, Dick. Good afternoon to everybody. My name is Riccardo Pizzeghello. I work in the Financial Stability Directorate of the European Central Bank. But as Dick said, I had the chance recently to work and collaborate with the Volatility and Risk Institute on the project that I am presenting today, which is about the extension of the SRISK framework to global banks that are not listed on financial markets. So the plan for my intervention, I think, is pretty simple. On the first part, which is actually the most consistent, I will try to give you as much details as possible on the methodology that we developed for estimating SRISK for non-listed banks in the euro area. This is based on a paper that was recently published on the Journal of Financial Stability, and it is linked on the slide if you're interested. And this should provide like 99% of the background that is needed to understand the framework. The second part of the presentation is just a couple of slides and is really about the work that we did at the NYU over the summer about the extension of the methodology originally developed for the euro area to a sample of global banks, as long as with some improvements of the original modeling framework and some work that we did to automatize the analysis to ultimately publish the results on the volatility laboratory. So I think it's worth to start with a couple of words of introduction for who is not completely familiar with the SRISK indicator. This is a measure of systemic risk, and you can see the official definition on the slide, along with the equation that you would need to calculate it. But the way I like to see it is really as a framework for market-based stress testing, because with SRISK, you really get a measure of how much capital is depleted in the event of an adverse shock in the economy. And it's a simple but super powerful tool for this kind of assessment, especially if we consider the costs that are associated with the regulatory stress test, the time that it takes, and the resources that are implied for such an exercise. So overall, SRISK has a lot of advantages. One main limitation is that it can be applied only to listed institutions. And if you see the equation, I have highlighted equity, which stands for the market capitalization, and the beta, which are elements for which you would need stock market data to retrieve the numbers. And in the European landscape, this limitation is quite impactful, especially if you consider that 50% of the banks that we have is not listed, and they represent roughly a third of the total assets of the overall banking system in the euro area. So focusing on a set of about 180 significant institutions, the objective of the paper were essentially two. The first one was to perform a standard prediction exercise using a panel regression, where essentially we estimated SRISK using some balance sheet information from banks that are listed, and then we predicted it for banks that are not listed. And then, given that this is sort of an unsupervised exercise and we don't have a benchmark to understand whether estimates for non-listed banks are good or not, we wanted also to validate, we decided to validate the estimates against the regulatory stress test, which is an exercise that produced quite some interesting and positive results that at the beginning we're not really expecting. So to estimate the relationship between SRISK and listed banks fundamentals, we essentially developed two main avenues. The first one is what we label the direct estimation approach. This method is the simplest one, and it involves a panel regression essentially of SRISK, in this case as a ratio of the total assets. While on the right-hand side of the equation, we have a vector X, in this case of banks fundamentals, some time-fixed effects, and a dummy for banks that are operating in peripheral countries that are Italy, Spain, Portugal, Ireland, and Greece. So we played around a lot with book values of assets, of equity, profits, some regulatory ratios, and some variable transformation to test for potential non-linearities. And we end up with some specification that we were satisfied of. The key driver of risk in this case is really the size of the bank, and this is reasonable as the bigger the bank is, the higher the complexity, the interconnection, and ultimately the risk. However, if you look at specification 3 and 4, you can already see that the effect of the size might be non-linear, and this is the coefficient of the log of the total assets squared. That means that when the bank reaches a certain size, there is a diversification effect that kicks in and the risk is gradually reduced if the bank grows more from that point onward. Among the other balance sheets that we investigated and that are significant, you see profits and leverage have a negative and strongly significant coefficients. This signals that banks that are more profitable or banks that operate with high levels of capital, they tend to have a lower S risk. And then on top of this, other thing that is interesting is that banks that are located in peripheral countries, they display a higher risk compared to their competitors in other jurisdictions, all the rest being equal, of course. So on the slide, you see specification 1 is highlighted in red just because it will be used to produce the results that are following in the rest of the presentations. The other method that we developed is what we call the indirect estimation. This is very similar to the other one, but is based on 3 steps. The first 2 ones, we have 2 panel regressions, which are used to kind of model the relationship separately between the market value of the bank and the beta against our usual vector of balance sheet variables. And then once we get the estimated market capitalization and the estimated beta, we plug them into the SRISK equation, which is equation number 3 in the slide, and we get our estimated S risk. On the right, I have a couple of tables, some selected specification because I don't think there is time to kind of discuss all the specifications that we have on the paper, but they should give you at least an idea of how the models look like. For the market value, the overall performance, including the one of the specifications that I'm not reporting, was very, very good, and the R squared was always above 70%. We got some results that are consistent with the standard asset pricing models, for which the idea is that the value of the firm is given by the future stream of profits. And indeed, if you look at the coefficients for the profits, they have a large and positive impact on the market value. It seems also that there is a premium, which is associated with the size of the bank. And if the bank increases equity, this tends to increase S risk after a certain point because the market seems to price in the higher cost of capital. The beta regression was probably the most difficult model that we had to calibrate, and reasonably it seems that the banks with good profitability are less exposed to market risk, and also that large banks are on average riskier with some nonlinear effects also in place in this case. And also here, similar to what we saw for the direct estimation and the market cap, operating in a peripheral country seems to kind of penalize the bank in terms of risk compared to the peers operating in other jurisdictions. And then to conclude on this one, you can see that we decided to keep the models quite simple. So in principle, we could improve a little bit the performance of the models using like more granular balance sheet items. But then there is really a trade-off that arises, which is related to the data availability for non-listed banks that would prevent us from making predictions. So we decided to stay simple, having something clean that works well when it comes to prediction. So I won't go into all the robustness checks and performance assessments that appear in the paper. I think it's still useful to at least visually understand how the models perform by fitting them on the sample of the listed banks. On the left-hand side, we have some charts that essentially illustrate the aggregate S risk by country for a selection of 6 euro area countries. So all the considerations are on aggregate here, but most of these results are also valid if we look at individual institutions. This representation, I think it gives you kind of a visual sense of how good the model fit is, as most of the yellow and the red series, which are basically the predicted S risk, they are tracking quite well the S risk computed in VLAB, which is the blue line. There are some countries for which we have some small divergences over time. Some of them have been also analyzed in the paper and are mostly related to country-specific conditions, like the composition of the sample of the banks or bank-specific cases, because we are really working with a sample that is not super large. So sometimes there is still some little like skew introduced by some individual institutions. On the right, just briefly, we have the aggregate estimation error relative to the size of the banking sector at country level. And this chart, I think, is very nice because it shows that both approaches, direct and indirect, have quite a reasonable performance, and none of them is consistently outperforming the other, reinforcing the idea that the modeling framework is quite robust. The overall error stays below 1%, and this is considered to be kind of satisfactory to proceed with the prediction for non-listed banks. So based on this last consideration, the prediction for non-listed banks is based on the average output of the indirect and the direct and the direct estimations. This is to combine the benefits of the two methodologies and also to minimize their limitation. So on the left, for the euro area aggregate, the SRISK that is hidden among non-listed banks accounts for more than 30% of the overall SRISK, which is quite significant. At the end of the series, I think it jumps from like 900 billions to more than 1.5 trillion. So it's quite good we managed to kind of capture this. And the results on the right, you see, are quite heterogeneous across countries. And this, of course, depends a lot on the proportion of listed versus non-listed banks that are present, but also on the business model, the size, and the systematic importance of the banks, which can differ substantially from country to country. Bottom line, I think, is that really the overall riskiness at country level changes dramatically when including non-listed banks, and this underlines a lot of the importance of covering the gap. Then, as anticipated before, we wanted really to further assess the performance of the SRISK estimation model, and we decided to run a benchmark analysis comparing the SRISK outputs with the outputs of the European Banking Authority regulatory stress test that have been conducted in 2018 and 2021. So at this stage, one could immediately say that the regulatory and the market-based stress tests are substantially different, and that's why we took some measures to account for this in the following analysis. So in terms of methodological differences, the first one that I can mention is really how the scenarios or the shocks are modeled in the two exercises. The EBA one is based on a macro-financial scenario, which is constructed ad hoc every 2 years for each specific exercise, while SRISK is calculated by assuming a broad market downturn of 40% in our case. This is not really something we can influence, but it's not a big deal because in the end we will report the results of these comparisons in terms of correlation. So it's good to acknowledge the difference, but this doesn't, let's say, affect a lot the results. And the second one is actually that the European regulatory stress test is based on this concept of risk-weighted assets. This is a concept that was a bit criticized in the literature because it can introduce some bias, as they are potentially like the weights that we use to calculate the risk are partially discretionary. So to stay completely neutral in this comparison, we multiplied the left-hand side of the equation in the blue panel by the risk-weighted asset to eliminate the effect of this discretionarity. And we also implemented some transformations to ensure that the resulting numbers are comparable estimate of the capital shortfall relative to a prudential threshold of 8%, expressed in both cases as a ratio of the total assets. So results that we got are pretty nice. I tried to squeeze as much as possible in this slide. So on the scatter plot, you see that all the scatter plot essentially display the EBA shortfall, so the shortfall of the regulatory stress test on the x-axis, and on the y-axis, the shortfall, the capital shortfall calculated with SRISK framework for listed, non-listed banks, and all the methodologies that we discussed. So here, I think we can limit ourselves to a visual analysis. You see that the correlation is quite visible, although there is some dispersion that occurs, especially around those observations that have very small shortfall or even a capital surplus. So it is true that we lose a little bit of precision in the left tail of the distribution, but this is not a big concern given that we really want to be precise on those banks that are very, very risky and that are, let's say, for which the risk accounts a lot in the overall risk of the system. So on the tables, I reported just on some Pearson's linear correlation and Spearman's ranking correlation. Now, it's not a matter of going really into the single numbers, but you can see that those correlations are consistently high and positive, and this indicate that there is a strong alignment in the final results of the stress test, but also in the riskiness rankings that we get from the two exercises. And also here, you see that there are some mixed results for the two estimation methodologies. For the indirect one, like the indirect one tends to prevail for the listed banks, while the direct one prevails for the non-listed banks. And yeah, so just to sum up on some of the conclusions we have on the paper. So the first one, using banks fundamentals to predict SRISK produces good estimates. The model's performance and the prediction quality is very satisfactory. And also something that I didn't show is that the risk rankings that we get with the estimated SRISK are very well aligned with those that you can download from VLab. The estimation models have been tested quite widely and are robust to a variety of conditions. In the paper, if you're interested, we played a lot around with different specifications, but we also kind of tried to analyze the role of bank business models and some of the differences in the balance sheet structures of listed and non-listed banks, which was quite interesting. The indirect and the direct modeling methodologies complement well each other. They are not necessarily substitute. And then probably the most interesting conclusion is that the outputs of the regulatory and market-based stress test can be reconciled via accounting figures. This result is super important since it provides an explanation for the gap between the two approaches that has been also discussed in the literature. And it means that information that are embedded in the balance sheet helps to cover the gap and explain the results of the regulatory stress test with the market-based stress test. So all of this should provide quite a strong ground to extend the methodology beyond the euro area. So I have just a couple of slides before finishing on the work that we did at the NYU over the summer. So to expand the euro area methodology, we implemented a direct modeling estimation on a sample of global banks. Given the sample is now global, we decided to work on separate regressions for different groups of countries, which is intended, to make sure that we capture differences in the banking system of different regions. For each set of countries, we calibrated two different models, two different regressions in parallel to have at least an option, to choose the best for each region. The first one is sourced directly from the paper that I just presented. And on the right-hand side, you see we have assets, we have net income or profits, and the leverage. And the second model is sourced from a work of Engle and Jung, who estimated SRISK for Latin American non-listed firms in a very similar fashion. And here on the right-hand side of the equation, we have assets, we have some non-linear effects, we have equity, and we have leverage. And along with extending the framework to improve the country coverage, we worked quite a lot to increase the frequency of the estimation to monthly. Quarterly was already kind of good from a stress test perspective, but might be considered low, for example, if we want the tool to issue some effective early warning signals. So even if fundamentals are available at a quarterly frequency, you see on the left-hand side of the two equations, SRISK is aggregated at monthly level, and this is captured on the right-hand side of the equation by some monthly time-fixed effects that allow us to capture the variability that is needed to increase the frequency. And with this new methodology and new data, the worldwide picture after including non-listed bank looks something like these three charts. Starting from the right, which is Europe, the share of systemic risk from non-listed banks is quite relevant here. We are talking about 35%, which is very consistent with the results we got in the paper with a completely different set of balance sheet variables. In the Americas, SRISK is a little bit more volatile, and the share from non-listed banks is within 20 to 40%, depending on the period. And this volatility comes mainly from Latin America. In Asia, the hidden SRISK is a little bit lower, only around 15%, and this is partially because of some data availability, especially for those banks that are operating in emerging economies. And this allows me to stress a lot that the quality and the coverage of balance sheet data is crucial here. This was somewhat a first iteration, which produced some nice results, but the work is still ongoing and will probably be refined in the future. So with this one, I think I can conclude. Thanks to all for the attention. I hope it was interesting and sufficiently clear. These estimates will be soon available as part of the systemic risk analysis in the volatility laboratory for free download to everyone if you are interested in doing more analysis. And on the first part of the euro area, there is much more on the paper that I cited at the very beginning. So if you're interested, you can have a look there, or you can just note down my email address and ask any question. I'm super happy to chat about this. Thanks a lot.